Okay, so now we are to the key portion of this class, which is going to be the strategy outline. This is not the why, but this is the how. But I did the why first because you need to understand why you're doing something before you understand how to do it. So let's talk about this. How many of you have heard of standard deviation? Well, I'm pretty sure mostly everyone, right? But the entire goal is to take advantage of standard deviation. And now, if you haven't heard of it, don't feel bad. We're going to go over it in very, very strong detail. But you may have also heard of expected moves or the average true range. These are slightly different words and slightly different ways to quantify that essentially, the way that a stock moves. Yes, it's going to have a parabolic move sometime that's out of the ordinary, but for the most part, stocks move within a specific range that can be quantified, okay? Now, like anything, especially in the stock market, yes, there are surprises. But for the most part, stocks are going to move it within a specific range, and it's those ranges that we use to trade them from and make money off of. So, yes, like I was saying, sometimes they are going to have a greater than average or greater than expected move. But that's what the squeeze is for. That's where we focus on our directional trading that looks like that. Okay? This is also how we maximize gains in a directional market. But what it's important to understand is that there are chips on the table, the boring moves, that can be taken advantage of if done correctly. So that is what this class is all about. The next piece of that is, what is the strategy? The 7 stocks to success method means using the calendar and 7 high premium stocks to sell credit spreads with out of the money premium about 8 to 9 days till expiration to look for slow and steady theta decay. Now, you might look at this and say, well, isn't that a bit fast? Yes, it is a little bit fast, but that's how I like to do things. If you want to adjust it, and if you want to say, okay, well, I'm actually going to do it 21 days till expiration instead, that's fine. You just need to update the parameters on your spreadsheet, and then it will pop out those numbers for you. But the way that I'm doing this and the way I'm teaching it is the way that I actually used it. So, it was about 8 till 9 days till expiration. With the strategy, I would sell premium on Tuesdays or Wednesdays and then close the next Tuesday or Wednesday. But if the stock had moved decently away from my short strike, I would hold and let the spread expire worthless on Friday for full credit. So, essentially what you're looking at is getting in on Tuesday, then getting out the next Tuesday. It's really within a week or so. And then with that, you can see, okay, well, am I making money? Can I hold it longer? And the management really comes as far as how much the stock market has moved. But we're going to get more into that in detail later on in this presentation. Now, a key portion of this is selling premium. Now, I believe that many of you are familiar with selling premium. Why are we talking about this to begin with? Well, as options traders, we have a really wide variety of options, no pun intended, available to us, and different strategies take on more or less risk. Now, when you're taking credit spreads, either put credit spreads or call credit spreads, and then you're comparing them to debit spreads and long calls, what you're going to see is that long calls are much more risky than something like a spread. Well, why? Because spreads have defined risk, and the main reason is because it can make you more money if the market trades sideways or slightly higher or explodes higher. In the instance of long calls, yes, they're great as far as the best opportunity for reward and percentage gain, But unless the market basically goes and explodes higher, your long calls just kind of sit there and decay. So what we're trying to take advantage of as far as the call credit spreads and the put credit spreads are concerned is that, number one, they're easier to hold in a volatile market, but they also make money in multiple different market directions, which means that, if the market moves sideways, or if the market moves up, or if the market moves exploding higher, you're still making money on a put credit spread. The one instance where you're not making money is if you sell a put credit spread. For example, like if you sell a put credit spread right here, and then the market rolls over and dies and it falls through it. But in the rest of the situations, you're still making money. So that's why I say it's the least risky. Now, the main source of risk with any strategy, we always have to talk about the risk involved, because I will never ever sit here and tell you that there's no risk involved and don't worry about it. No, you always have to look at your risk. You have to learn how to quantify it. And the two main pieces here for me is that you have the risk of being assigned, and that's because we're selling credit spreads outside of standard deviations. The risk is honestly pretty small, but you do need to be aware of it in case there's some type of crazy flash crash. The next piece of that is having a less favorable risk to reward because the spreads are out of the money. So you're not going to be able to get a one-to-one risk reward when you're selling out of the money. It's not going to happen. But because it's so high probability, then, you look at the probability instead and you say, okay, well, this is working 90% of the time. So, if I'm going to lose a max loss on it 10 times, then is that worth it to me? So that's also another reason why you can utilize strategies like alerts, something like that. But we'll get on into that later on in the class. So keep in mind, there's never an option strategy without risk. So what we focus on here is how to mitigate it. All right, so I know you've been dying to learn what are the 5 components of a successful trade in the 7 stocks to success method. Let's take a minute and look at this. All right, so what is a setup? Every setup, well, first of all, every strategy, it needs these 5 components, okay? Every single trade. So what are the components here? First one is going to be the setup. We have the stocks from the 7 stocks list, or any other stock that meets the parameters of the setup. And that's the very basis of it. You have to have a stock that fits within your parameters, and then you have to look for a strategy. What is the strategy here? In this strategy, what we're doing is we're selling premium on a Tuesday and or Wednesday for the following week's expiration series. So for example, today is Monday, July 22nd, which would mean I would be looking for the next week option expiration series, which would be August 2nd on a calendar. So if I got into those positions tomorrow, I would be looking at about 9 days till expiration, and that is how I use the strategy. So the next piece of that is going to be your entry. Now, of course, most of you know me, and for those of you who don't know me, I do love focusing on after an entry after a pullback. Why? Well, because when you're looking at a trending stock and it pulls back, you're going to have a better opportunity to get in at the low. Now, I'll tell you that when I did this strategy, I didn't even know how to look at a pullback, and I didn't even consider that, and so I just did it based on the calendar. Now, as I've gotten better, yes, I focus on the pullback. So depending on who you are, if you know how to quantify a pullback, great, add that. If you don't, I would just use the calendar just like I used to do. Now, as far as a stop goes, so normally on a lot of my different trades, like I won't use a stop, but because this strategy is about a 3-to-1 risk scenario, I do like to use the 50% stop loss. So keep that in mind. The next piece of this is a profit target. Obviously, the best target would be the spread expiring worthless, but you always need to have a first target in mind, and a great first target is about 50% the width of the spread. So And that is the 5 components of a successful trade for the 7 stocks to success strategy. Now, let's break this down and talk about it a little bit. Why Tuesday and Wednesday? Well, the 7 stocks to success method means that using a calendar and 7 high premium stocks to sell out of the money about 8 to 9 days till expiration to look for slow and steady theta decay. So why Tuesday and Wednesday? Well, I've never really traded too much on Mondays, and on Monday, you're generally just trying to get a feel for the market after the weekend. So what I would do is I would go into Monday, I would look at the market, see what it's doing, and then I would start setting up my trades for Tuesday, and I would get into my trades on Tuesday. I found that if I got into them on Tuesday and Thursday, I would get Tuesday and Wednesday, I would get the best prices. And by the time it got to Thursday, the premium was decaying even more, and so the prices weren't as favorable. So I think that if you get in the morning on Tuesday, start setting them up in the afternoon on Monday, that's the ideal situation. But sometimes if a ticker pulled back on Tuesday afternoon, then I would wait for a better entry on Wednesday. So what about the exit? Well, if the stock has moved away decently from my short strike, I would actually hold. So instead of holding it for only a week, I would instead let it expire. I would hold it, so for example, and I have calendar coming up here soon, but if I got into a position on Tuesday, and then there's Wednesday, Thursday, Friday, Monday, Tuesday, if the stock price had moved decently away from my short strike, instead of closing it on Tuesday, I would just wait Wednesday, Thursday, and Friday and hope, by that point it would expire worthless. Now, if we're in a situation on Tuesday where it's kind of borderline across the strike price, that is the instance where I would close it. I would take kind of my 50% profit, and then I would move on. So it really just depends how it's trading and what I'm looking for. So why did I get in on Tuesdays and Wednesdays? Well, it's because of theta decay. So options expire on Fridays, and that's when the theta decay is the quickest. With this strategy, what you're focusing on is theta decay. Okay? So, in this instance, if you sell on a Monday, Tuesday, or Wednesday, there's more premium to sell. If you get in too late in the week, the premium has been decaying, leaving less premium for you to sell, and then that means your risk reward is now worse than it was on Monday, Tuesday, or Wednesday. So, the fact that it decays is great. I mean, that's what we want, to make money. We want to make money on premium decaying positions, but we have to time it properly. So let's go ahead and look at a graph of time decay. This is our theta decay right here. Well, you'll notice that this graph has quite a bit of time, 120 days all the way to 0 days. Well, the part that we're focused on right here is this. Okay, we're focused on the most rapid decay. So by getting into something about 2 weeks ahead of time, 8, 9, 10 days, that's basically going to be your quickest decay window. Now, if you say, hey, I'm not really comfortable using 8 days, 9 days till expiration, well, that's fine. You can push it out 15 days, you can push out 30 days. You just want to make sure that you use your spreadsheet accordingly so that you're getting the right numbers when you're using your spreadsheet. So, for example, let's look at a calendar. This is a way that I always used to do this. Like I said, I didn't like to trade on Mondays. Forget about Mondays. Who likes Monday? So what I would do was I would get in on Tuesday and I would hold. If I was really up and everything was looking great here, I would get out. If not, I would hold it over the weekend for more decay, and then I'd wait until the next Tuesday and I'd get out then. Now this is for a position that expires this Friday. Okay, so if I got in here, it would expire here. So by getting out here, I would usually be able to get like 50% profit on the trade. Now, of course, if you hold it longer, you get more of a profit as long as it's still going in your direction. So What does that mean? Well, it means that if it's going in your favor, I personally would leave it on longer. If it wasn't going in my favor, I would get out here and I would take the 50%. So what I would do is I would do this over and over and over again. I would get in here and get out here. Then I'd get in here, get in here, get out here. Just do the same thing over, roundabout. So how would you do this? Well, yes, I'm going to give you the 7 stocks list. I'm going to give you the parameters, but you also need a spreadsheet. This is the key part when it comes to math. You look at your Excel spreadsheet that I'm going to give you. We're going to go over that in just a minute. And the spreadsheet is going to enable you to pick the stock, type in the IV in the series that you're going to sell, and it will spit out strikes at 1 standard deviation, 1.5, and 2 standard deviations. Now, there's a reason why I put a couple different variables here. Number 1, each stock is different, but number 2, it's because different traders are different. So for example, your risk to reward is going to be the best at 1 standard deviation, but also it's going to be more likely that you're going to get stopped out. If you want to use 1.5 standard deviation, what that means is that you're going to be further out of the money and your reward is going to be less, but your risk is also going to be less. So you kind of have to decide, but this is the same spreadsheet that I used. I printed it off. 10 times every week and I would fill it out. So for example, I would look at this and I would say, okay, let's look at Shopify. What's the date? Is it Monday? Is it Tuesday? So let's say it's Tuesday, July. Sorry, it's not very good writing. 23rd. Then I would calculate, okay, well, what's the IV? We get that from our options chain. Let's say it's 50%. Let's say the expected move is $20. Okay, and then when you put that into your spreadsheet, it will give you all of this information. You don't even have to do math, nothing like that. And so when you look at the spreadsheet, you would then say, okay, well, let's go ahead and plug some of these numbers into my Thinkorswim, because I want to see the risk to reward. And when that happens and you switch over to Thinkorswim, you have to answer the question for yourself. What do you prefer? Choose your own adventure. Would you rather focus on better reward for a little bit more risk, or would you rather focus on very high probability for low reward? It's really just up to you how big of a size account you have. Now the next piece of that is going to be calls and puts. I go over this a little bit later on in the class, so I don't want to, hammer it in too much detail. But essentially, with the eyeball for the trend, obviously with an upwards trending chart, you want to focus on puts. If you have a chart that is going to be downward trending, you focus on calls. Now, if you don't really care, or if it's just more of a kind of a chart like this, you can do both. Do the calls on an up day, do the puts on a down day, calls on an up day, puts on a down day, calls on the up day, puts on a down day. But at the end of the day, you just need to look at the trade you want to do, decide the reasons, decide the risk parameters, note your risk, note what actually happened with it, and this is a part that I found really helpful as well. So when I'm looking at the ticker, what I want to look at are the ranges for this particular stock. So what happens when you're trading the same stock over and over and over again? You kind of become like friends. It's like your friend and you go out to the bar and they're going to be crazy. Okay, well, we want to avoid that, right? So we want to stick with something that has a range while avoiding something that's too crazy, okay? So if you pick a different stock instead of one of the ones on my list and you find that it's very crazy and parabolic and it doesn't really fit a pattern, that's why you need to take it off the 7 stocks of success list. The stocks that are on this list follow a reasonable pattern. They stick within a reasonable range the majority of the time, And that is how we make money with them. So we're going to explore it in a little bit more detail soon, but this is what the spreadsheet looks like. So you're able to take a stock, plug it in, plug in the current price, look at the implied volatility, note the days till expiration, the number of contracts, and how wide or tight you want your strike prices to be. Now, the best part about the spreadsheet is it's going to spit out these numbers for you. It's going to tell you, okay, well, if there's a 1 standard deviation move, it's going to be $16.92. And then it's going to give you the bounds for your different spreads. So, for example, if a stock is trading at $203, the 1 standard deviation move to the upside is $16.92. That would put your upper strike on the call side at $219.92. The next piece of that is, okay, well, what about a 1.5 standard deviation move? That would put your upper strike at $228.37. Next piece of that. What about a 2 standard deviation move? $33.83, $236.83. There you go. You have your numbers for you. And of course, it's not going to tell you, do you want to do upside or downside? But that's where the trend comes in. This right here is a really nice visual to say, okay, well, here we have the upwards trend. You have 1 standard deviation, 1.5, and 2 standard deviation, 1, 1.5, 2 standard deviation on the upper and the lower side. And here is your current stock price. And so it's telling you what a 1, 1.5, and 2 standard deviation move would look like. So like I was saying on the last slide, I really like to continually track the ranges in a given stock. This gives me an idea for how much a stock likely moves within a week or during a month-long period. It gives me an idea of their personality. So something like Amazon, it's going to move more than something like PayPal. But when you're trading the same thing over and over again, you say, oh, okay, well, that range is pretty normal, and how can I deal with that? All right, so I think this is about enough for this portion right here. So I'm going to stop this section of the recording, and then I'm going to talk about what happens when you get good. All right, I'll see you in the next episode.